So you want to start investing and create your portfolio, but are you wondering about the types of asset classes you should pick and how you can manage the risks that come with all investments? It can be intimidating to start building your portfolio in 2022, now that the stock market has gone crazy, but it's never too late to invest if you do it the right way. Hey, welcome to Stock Market Mate. Today, we'll talk about how to build a strong portfolio for 2022. We created this to cater to a long-term investment that will build your wealth over time. Make sure to subscribe to the channel and hit the notification bell to help us beat the YouTube algorithm. If you're done with that, then let's get right into it. Investing can bring you plenty of potential returns, but let's not forget about the risk that comes with it too. All investments carry a degree of risk. That's an important principle to always keep in mind. Building a financial portfolio involves combining different investment assets to maximize your returns and minimize your risks. You want to find an optimal balance that's right for your risk appetite and financial goals. While you can't completely eliminate investment risk, you can certainly manage it. The best way to navigate risk is to develop a diversification strategy for your investment portfolio and not rely on one single product or family of products for returns. Here are some steps you can take to diversify your portfolio. Cash. The first and least risky is cash. You should think about having at least 10% cash in your portfolio where it's safe and liquid. In case you see a good opportunity in the market, you can simply go for it. Having cash in your portfolio can also mean that you won't dip into your cash savings in your normal checking or savings account in case you see an opportunity. This also serves as your way of limiting yourself with the money you set aside for the purpose of investing. Some investors like to put more cash into their portfolio, while some don't have any at all. However, we think 10% is a pretty good amount. In your portfolio, cash can help cushion against volatility and enable you to take advantage of attractive investment opportunities as they arise. Investors who are approaching retirement turn their focus to preserving their savings, the closer they get to their retirement day. ETFs. The next part of our portfolio is ETFs. This can serve as the foundation of your portfolio because this investment will plug and chug an average rate of return around 8% per year. ETFs are also relatively inexpensive, offer higher liquidity and transparency than some mutual funds, and trade throughout the day like a stock. It can also provide security to your portfolio. Let's say, for example, that you put $1,000 into VOO. Your $1,000 investment is split among the 511 stocks that it holds. You should think about putting 25% of ETFs in your overall portfolio. If you're looking to diversify your investments, hedge your risk, or gain exposure to a certain industry or market, then ETFs may be the perfect asset for your portfolio. Blue chip stocks. Blue chip stocks are like Google, IBM, Apple, Amazon, Johnson & Johnson, and more. These large capitalization stocks are going to remain stable for the years to come. This is why many stock market investors prefer blue chip stocks due to their stable earnings. Blue chip stocks usually pay increasing and consistent dividends over time to at least partially make up for any temporary declines in the stock's price. Blue chip stocks are considered safe investment options as they can endure economic downturns and are not highly volatile. They also present a slow but moderate growth potential. These are typically dividend-paying stocks where the payment is made quarterly. Definitely look into companies that are profitable and have a healthy balance sheet. For the blue chip allocation, giving it 35% of your overall portfolio would sound rock solid. Growth stocks. As all investing, there's a fundamental trade-off between risk and return. Growth stocks provide a greater potential for future return, and they are thus equally matched by greater risk than other types of investments like value stocks or corporate bonds. A growth stock is any share in a company that is anticipated to grow at a rate significantly above the average growth for the market. Amazon used to be a growth stock at the time they were selling bricks and mortars. Suddenly, Amazon shook the whole e-commerce domain. Now it has become a very big company that's more classified as a blue chip stock. However, during that growth and innovation period in 2000 to 2012, it was more like a growth stock. The returns reflect, according to data from 2011 to 2021, that their stocks appreciated well over 158%. In contrast, the S&P index has earned a return of 287.5%. Basically, Amazon outperformed the market by 5.5 times. However, you should know that growth stocks are subject to volatility and not all of them are automatically great companies. So what should you keep in mind when choosing a good growth stock? Here are 5 things to remember and look out for. Number 1. A strong leadership team. Because growth companies are focused on increasing the profits and sales of the organization, the management team is going to matter a lot. Growing a company requires an innovative leadership team. Without it, growth won't happen. Growth investors looking for the next investment will want to choose companies that have a leadership team with a good track record and a reputation for being innovative. Think of Steve Jobs and Bill Gates as innovative company founders. While it may not be easy to spot the next innovator, investors definitely should do some research on the leadership team before investing any money in the stock. The last thing anyone wants is to get stuck with a company that's following the pack instead of leading. Or possibly even worse, will be gone in 6 months to a year. While great leaders have been known to post short-lived successes, taking a look at a company's management team before making a growth investment can be an easy way to weed out some potentially high risks. Number 2. A good growth market. For any sized company to grow, it is going to have to play in a market that's poised for growth or is already in growth mode. If the industry is at the tail end of its growth trajectory, it isn't considered a growth market. For example, today may not be the best time to invest in a personal computer hardware vendor, but it could be the right time to get into a mobile app startup. In addition to operating in a high-growth industry, the stock you choose has to have a commanding market share. You don't want to get stuck with a third or fourth player in an emerging growth market. Nor do you want a one-trick pony, which means investors should look for companies that will be able to sustain their competitive advantage. Is the company coming out with many innovative successful products, or does it continue to ride its first success? These are questions investors need to consider. Number 3. A record of strong growth in sales. While the industry, leadership, and market share of a stock all matter a lot, it's important to also consider the sales of the company. You want a company that is seeing an acceleration in earnings and revenue growth for consecutive quarters. The faster the growth rate, the higher the likelihood the stock will rise. After all, companies that are boosting sales and earnings are going to be attractive investments for investors. When it comes to the growth rate of a winning stock, there isn't any hard and fast rule. However, you do want to go with a company that has at least high double-digit growth. Number 4. Avoid overvalued stocks. Growth stocks are attractive to many investors because they are growing, but that doesn't mean you should overpay for a growth stock either. Growth investors want to avoid those stocks that have a big run-up because of investor demand or because fundamentals have declined but the stock price hasn't. Growth stocks that are overvalued will likely see share declines and eventually trade at a price that reflects its current fundamentals. Number 5. Large target market. Nobody gets rich selling a niche product to a handful of customers. For any business to grow, they need a large target market to hawk their wares to. For growth investors, the companies that are serving huge markets are the ones to go after. The bigger the pool of potential customers, the greater the chance of success there is. For example, consider Apple and the iPhone. Without a massive market, the iPhone wouldn't have seen so much continued success. With those in mind, you shouldn't think about putting 25% of your allocation on growth stocks. Of the 25% chunk of your portfolio in growth stocks, feel free to go all in with just one stock or split that 25% allocation up into a few different companies as you like. Just remember the quick list of things to look out for when choosing a growth stock. This portion of your portfolio is for higher risk plays, so you must be okay with earning some and losing some. So we are left with 5%. This can be pretty flexible, and you can choose what to do with it. You can add this to your cash portion or to the growth stocks. However, you can also think about putting that on crypto. It may attack a bit of risk, but the potential upside is vast. Well, that's about everything. If you found this video helpful, kindly click the like and subscribe button. Also, you might want to leave a comment below. We love hearing from you. Thank you for watching, and we'll see you in the next video. If you enjoyed this video, you're going to want to watch one of these two videos right here. Enjoy!